Hey traders, in this video I'm going to answer a question about my options trading and how I trade the options. So let's get straight into it. Guys, do not place a trade based on what you see in this video. Trading is risky and it can cause substantial financial loss. There's no guarantees of making money in the markets. So be smart about the way that you're trading in these markets. All right, cool. So the question was from Nick, and Nick said, why do you trade? Now this is in relation to a video that I did before. He said, why do you trade first in the money, first in the money option there? If short-term trading, wouldn't you want the higher delta? Cheers and thanks for your great videos. It's actually a great question there, Nick. And let me actually bring up, say this is the DIA, which is the ETF limit with the Dow Jones. And let me bring up this section through right now. This is the, let me bring up the calls and the puts. I'm going to bring this back down through here. This is the options here. If you don't know what options are, that's fine. But I'll just calls and puts, and I'm just going to make it through there. Okay. So what I like to do, say for example, right now when I'm trading December options. Reason why is because I like to have at least 30 days, 30 to 60 days seems to be the sweet spot for me. Now he asked, the question was, why do I trade in the money options? Aren't I looking for the higher delta and all that sort of stuff when it comes to that? And the thing is that you said that wouldn't you want a higher delta? So for example, if I'm trading, you're asking about the higher delta there, Nick. If you actually look at, say for example, DIA as an example, these gray bars is what's actually in the money, which is basically below the price. And let me actually bring this over here. So yeah, so the current price is 256, 256.23. So 256 is first in the money. So you're saying about getting a higher delta there, Nick. But as you can see, right, that as you go in the money, you actually get a higher delta. As you go out of the money, you get a lower delta. Makes sense? So in the money is actually below the price. That's the first reason. I never trade just because of the delta. I didn't care about that. What I'm looking for is I'm looking for a buffer. I'm looking for to buy something in the money, because if it is a losing trade, I can get out of that trade with a 20 or 30% loss and the loss be quite small. Sometimes a lot smaller, right? So for example, if I was looking to trade the Dow right now, the DIA, let's actually bring this over here, say the last 3 months. Right now it's 256 as an example. 255, then you got 255, 254. So I'd probably be looking at, say, the 251. So I'm probably looking at the 254 to 253. Now, because these are dollar increments, I'd want to have a bit more of a buffer than that. Say 255, 256 is basically right near the price. So I'd probably be looking at around about, say, the 254, 253. And the reason why is that gives me intrinsic value. From wherever the price is right now to that strike price, it gives me intrinsic value. It gives me a bit of a cushion there. So if it goes against me, I can still get out of that trade. Now, obviously, I have my trading plan and my trading setup, and it tells me when to get in, get out of the trade. But that's the reason why I personally like to trade in the money and out of the money options. Because if I'm going to go in with a 5 or 10 or 50 or $100,000 trade, I want to make sure that I can get out with a, most of the time. Sometimes you're going to get smacked, all right? So it's not saying all the time, but most of the time I can get out of an in the money option trade for a 20 or 30% loss, especially when we've got definitely a nice buffer there as well too. So a nice buffer going through there. Makes sense? So that's the reason why I like to trade in the money options. It's basically a buffer there, a cushion. So if so when I start to place more money on per trade, if I want to do a 5 or 10, or even 20 or $50,000 trade, I'm not truly worried about that. Now, yes, the worst can happen and completely turn around. You have a 50 or 60 or 80% loss. That's possible. So you need to accept that up front. But it gives me a bit more of a sleep at night factor that if I'm trading good stocks and so on and so forth, that's not likely to happen. That may happen maybe once a year or maybe once every couple of years. That's going to happen. But most of the time, I can get out with a small loss, sometimes even a 10, 15, 20% loss, and get out of that option when it's not moving for me. I can keep my option. I can keep my losses small, but then when the market does move for me, I can get out with a 50 or 100% profit. See what I mean there? So 20 or 30% loss. And that's my losses, and then my profits are like 50 to 100%. So you can see that even if I'm 50-50 right in the market, which I'm not, I'm a lot more than that. You can see the reason why now I trade the options the way that I do. It's all about, to me, it's all about risk management in the markets. I want to say, I want to be, if this trade's not going to work out, I want to make sure I can get out of it with as little as risk as possible. Before you go, make sure you grab the free Grab the Markets by the Balls training course. In this training course, you're going to learn the top 13 deadly mistakes, the success formula, charting boundaries, the PT method, the ultimate trading system, the blast off trading system, #1 in trading indicator, the $1 million trade and money management, how successful traders approach the market, and so much more. Get this training course for free right now. Click on the very first link in the description to get this whole complete trading course to give you the edge on your side of trading this market. Do that right now, and I'll see you on the other side.